Welcome to Talk Tickers. You're here for a breakdown of Interco's latest earnings call, the one covering the first quarter of 2025.
Yeah, we've gone through it, listened to the global CEO, the Brazil CEO, the CFO, and we're going to pull out the key numbers and, the strategic insights.
Exactly. Think of this as your fast track to understanding what really matters, both for Interco itself and maybe, the wider market picture.
So let's start with the highlights, the main results.
Okay, yeah. So headline numbers. Interco reported, a strong quarter overall, both financially and operationally. They're still pulling in customers like crazy. Another 1 million active clients added.
That's the 5th quarter in a row they've done that, right?
5th in a row, yeah. Reaching a 57% activation rate, which is pretty solid. And business clients, up 23% year over year. That's 2.4 million now.
That consistency, adding 1 million actives quarter after quarter, it really shows their acquisition engine is working. And the business client growth is notable too.
Definitely. Now, looking at transactions, their TPV, transaction payment volume, that's a nice 33% jump compared to last year.
Yeah.
Reached 342 billion REI.
Wow. And how much of that was PIX?
A big chunk. 315 billion REI went through PIX. They're saying they've grabbed about an 8.2% market share there now.
That's significant penetration in the PIX system.
Yeah, and their newer credit stuff, PIX financing, buy now, pay later, what they call consumer finance 2.0, that portfolio grew more than 5 times year over year.
5 times, okay.
Yeah, hit 920 million reus. And get this, their brand new private payroll loan pulled in 150 million in credit in just its first 10 days.
Okay, that's a fast start, clearly tapping into some demand there.
Yeah.
The whole consumer finance 2.0 angle seems to be really gaining traction.
It seems like it. Moving on, assets under management, AUA, grew 54% year over year. That's 146 billion now.
Impressive growth.
And they're making inroads in Treasury direct balances too. Almost 4% market share now, gained 80 basis points in just 1 year.
So they're competing effectively in the investment space as well.
Right. And insurance, record growth, nearly 8 million active contracts. That's up 51% in 1 quarter. Sold 3.5 million items.
Whoa, 51% in a quarter. That's huge. Shows the cross-selling power, I guess.
Must be. Marketplace GMV, gross merchandise volume, that grew almost 30% year over year to 1.3 billion. And 8% of that came from buy now, pay later.
Okay, so BNPL is feeding into their marketplace activity too. It's all kind of integrated.
Exactly. Globally, their client base is up 41% year over year, 4.1 million clients. And the loyalty program's big now, over 12 million members.
That loyalty program seems key to their engagement strategy.
It used to be. Okay, total loans grew 33% year over year. That's like 3 times the overall Brazilian market growth.
Outpacing the market significantly. What's driving that?
Mostly FGTS and Home Equity loans. They grew 43% and 45% respectively. And those private payroll loans we mentioned, originations hit nearly 200 million by quarter end.
So focusing on those collateralized, potentially lower risk loan types.
Seems like a core part of the strategy. And importantly, asset quality looks better. The 90-day past due ratio is back to where it was in 2022. Cost of risk improved to 4.6%. Coverage ratio is up to 143%.
That's crucial. Growing loans fast is one thing, but doing it while improving asset quality, that's pretty good execution.
Yeah. Funding also grew strongly, up 35% year over year, over 59 billion raised now. Mostly driven by time deposits and that My Pig Bank product they have.
A solid funding base then.
Looks like it, which feeds into revenue. Gross revenue hit 3.2 billion, net revenue 1.8 billion. That's year over year growth of 38% and 31%.
Strong top line growth.
And they're getting more efficient. Efficiency ratio down to 48.8%.
Sub 50, that's a good direction.
And finally, return on equity, ROE, excluding minority interest, reached 12.9%. Record net income too, 287 million raised.
Okay, so profitability is definitely improving. That ROE is moving up.
Right. So that's the snapshot. Now, let's dig a little deeper into some of these areas. What's really driving this? Starting with client growth and engagement.
Well, that consistent 1 million new active clients a quarter, it suggests their acquisition funnel is really well-oiled. They talked about improving the onboarding flow.
Yeah, and hyper-personalization seems key. They mentioned using their customer service bot, Bobby, to personalize the homepage based on interactions. Said it boosted conversion by 12%.
That's clever, using service interactions to drive sales or engagement. And it sounds like business clients are getting more engaged too, moving up their service tiers.
Right. And the loyalty program members, they're apparently the super users, generate way more AR pack average revenue per active client and use like twice as many products as non-loyalty folks.
So the ecosystem effect is real. Get them into the loyalty program and they become much more valuable customers.
Makes sense. Okay, what about core banking performance?
Well, they noted Q1 seasonality, lower liquidity, fewer transactions sometimes.
Right, typical Q1.
But despite that, TPV still grew strongly year over year. And importantly, the average payment volume per client, the PPV, is going up across different cohorts. People are using INTR more.
And they're grabbing more PIX share, as we saw.
Yeah, that PIX market share gain is pretty significant.
Let's talk credit portfolio. That consumer finance 2.0 stuff is growing incredibly fast. PIX financing, BNPL.
Exploding, really. And they sounded really excited about the new private payroll loan.
They did. Why the excitement?
Well, they highlighted it's fully digital, low distribution costs, scalable, and crucially, it's collateralized. They see it as another, quote, secular shift opportunity.
Like FGTS loans were for them.
Kind of like that, yeah. Another big collateralized market they can digitize and scale up in. They're also reshaping their credit card portfolio, seeing more installments.
Okay. And this new INTR card, what's the deal there?
So the plan is for a totally digital, pre-approved credit line. The idea seems to be to get people using it for PIX credit and for buying stuff within the INTR platform.
Potentially cutting out the traditional card networks and their fees.
Potentially, yeah. Disintermediating the network fees on those internal transactions. It could be a big deal for their ecosystem if it takes off.
Interesting. Okay, moving to investments and insurance.
Strong AUA growth. Engaged investment clients, gaining that Treasury Direct share we mentioned, all positive signs.
And insurance had that record quarter. What drove that?
They put it down to targeted quality products and, again, hyper-personalization. FGTS and Saudi Zanaya products were apparently big sellers.
So knowing the customer and offering the right product at the right time?
Seems to be the strategy.
What about the marketplace and their global efforts?
Marketplace GMV growth was solid, almost 30%, and BNPL is definitely helping there, providing 8% of the volume.
So the integration works.
Yeah. And global client base growth is accelerating. Same for deposit balances from global clients. They also launched investment accounts for Argentinians via a partnership.
Expanding the model.
Exactly. Mirroring what they offer Brazilians with the global account. The vision seems to be serving premium clients with dollar products, maybe playing some arbitrage opportunities too.
Got it. Let's circle back to the overall loan portfolio and asset quality.
Okay, so they're outpacing market growth, especially in FGTS and home equity, focusing on profitable, sustainable credit.
And asset quality is improving.
Yeah, 90-day past due ratio down, cost of risk down, coverage up, all good trends. NPL formation was stable.
But they mentioned an increase in stage 2 loans. What was that about?
Right, they explained that. It's mostly due to a regulatory change, Resolution 4966. It forces them to reclassify some loans from stage 1 to stage 2 if they have a higher probability of default, even if they aren't past due yet. So it doesn't necessarily mean credit card performance itself got worse.
Okay. Regulatory mechanics, not necessarily underlying risk increase.
That was their explanation, yes.
Funding and revenue, strong growth in funding, right? Driven by time deposits in my pig bank.
Yeah, and they have a healthy loans to deposit ratio and boast a really low cost of funding, which is a big advantage.
And that helps drive the strong revenue growth we saw, gross and net revenue up significantly.
Right. They did mention fee revenue was a bit soft due to seasonality, that regulatory change affecting free recognition, and some one-offs.
But net interest income, NII, was strong.
Very strong. Driven by shifting the mix towards higher yielding loans, repricing existing loans, and getting better returns on their own investments. They expect ARPAC growth to pick back up in Q2 as credit penetration increases and that fee deferral impact fades.
Makes sense. What about expenses and efficiency? They got the ratio down below 50%.
Yeah, they actually managed a nominal decrease in total expenses. So the efficiency improvement is coming from operational leverage revenue growing faster than costs.
And they expect more of that.
That's the plan. Keep top-line growth outpacing expense growth. Key costs are people, tech like cloud computing branding, and fixed costs. They mentioned focusing on getting better leverage from tech contracts.
And AI. Are they using it much?
They highlighted its growing role, yeah. Both for cost savings, think customer service automation, fraud detection, and for revenue generation through that hyper-personalization we talked about.
So it's becoming a core part of the operation.
Seems like it.
Okay, let's talk NM net interest margin. They updated the methodology.
Yeah, they tweaked it for what they say is better reflection of financial performance. But the key takeaway is consistent growth in both their old NMM 1.0 and the new one 2.0.
What's driving the NIM expansion?
It's a few things. That mix shift towards higher ROE products, FGTS, home equity, consumer finance 2.0, private payroll, also increasing rates within those portfolios as they reprice, and better yields from their own investment portfolio.
So multiple factors pushing margins up.
Exactly. And they pointed out their risk-adjusted NIM is growing even faster, which suggests the quality of the growth is good.
All right. What about guidance and the outlook? Did they update their big plan?
They reaffirmed confidence in hitting the 630-30-30 plan goals. That's 30 million clients, 30% efficiency ratio, and 30% ROE eventually.
Ambitious targets.
Very. For this year, they're guiding for loan growth of 25-30%, excluding some receivable prepayments. They think the private payroll loan will add to this without cannibalizing other products.
Okay. Any projection for that consumer finance 2.0 portfolio?
Yeah, they think it could reach around 1.5 billion raise.
And what about macro risks? Inflation, interest rates? Are they worried?
They said they haven't seen a significant impact. They attribute this resilience to their strategy that INTR by design focus on collateralized loans and careful risk management. They stressed focusing on sustainable products that work for everyone.
Okay, so bringing it all together, for someone looking at this from an investment angle, INTR seems uniquely positioned, right? Capitalizing on Brazil's shift to digital banking.
Definitely. Their strategy feels differentiated, focusing on collateralized credit, diversifying revenue streams beyond just unsecured lending, which some competitors lean heavily on.
And the strong client growth, the engagement metrics.
Yeah.
They suggest the super app platform strategy is actually working.
Yeah, and the improving asset quality and efficiency show they're managing the growth relatively well, demonstrating operational leverage and decent risk control.
Plus, they're not standing still. New products, like private payroll, the Intercard idea, they're still innovating and pushing for more market share.
And the global expansion, starting with Argentina, that opens up a whole new avenue for growth down the line.
Okay, let's transition to our favorite segment. This is not financial advice. Time for some outrageous but plausible trade ideas based on all this. You go first.
All right. Idea 1. Given INTR's strong growth in collateralized stuff like home equity and FGTS, and how they mentioned competitors might be pulling back a bit in mortgages, maybe a pair trade.
Okay.
Long Interco short a major Brazilian bank that's heavily reliant on unsecured consumer loans. The thesis is INTR's lower risk book outperforms in this environment.
Interesting. Playing the perceived difference in credit risk and strategy. Okay, my turn.
Let's hear it.
Trade idea 2. Thinking about that Intercard launch. The goal is disrupting interchange fees, keeping more transactions in-house.
Right, the closed loop potential.
So maybe long Interco, but pair it with a small short position in one of the big global payment processors, Visa, MasterCard, someone like that.
The idea being if Intercard works, it chips away, even just a little, at the volume going over traditional rails within their ecosystem.
Exactly. It's a long shot, maybe, hence outrageous but plausible, but it plays on that potential disruption theme.
I like it. Definitely food for thought.
So wrapping up, Interco's earnings call really showed a company firing on quite a few cylinders. Strong growth, improving profitability, clear strategic execution.
Yeah, their focus on innovation, sticking to that sustainable, often collateralized growth model, and pushing for efficiency seems to be serving them well in the current landscape.
Of course, we always say past performance doesn't guarantee future results. But the trends and strategies discussed today definitely give you, the listener, a lot to think about.
Absolutely. We definitely recommend you check out the full transcript yourselves, do your own research.
And let us know what you think. What's your take on INTR's global plans or the potential impact of Intercard? Find us on social media and join the conversation.